everyone. Are we ready to begin?
Yes.
I trust everybody's staying safe with the weather and the ice and continues to stay warm. We've been blessed with not having the problems that are being faced in Texas. I can't imagine what those families are suffering through. The first item on our agenda is to approve the minutes of our January 22nd Development and Finance Committee meeting. May I have a motion to approve?
So moved.
Is there a second?
A second.
It's been moved and seconded. I will add my approval, and we are unanimous. The first discussion item we have is that regarding 4 units that serve persons with cognitive disabilities administered by Jubilee. And this is some units that are near and dear to my heart. Corinne,
Yes.
are you or Jay going to be presenting this?
Good morning, commissioners and everybody else. For the record, I'm Kareen Brown, Deputy Executive Director, and Jay Shepard will cover the key points for this item, in which we're requesting approval to sell units that are owned by the commission for this to serve this special needs population. And because these units are in an ownership entity with debt associated with it, we'll also be requesting other actions by the commission, committee and the commission that are covered in this packet. And so I'll turn it over to Jay to walk you through the main points, and I'm sure there will be questions which we will answer for you as well. So with that, Jay, please begin your discussion.
Yeah, good morning, everybody. Happy Friday.
Good morning.
So I'm Jay Shepard in the Real Estate Development Group, and we're going to cover the packet. If you have any questions along the way, feel free to stop me and we can address those. So starting on page 7 of the packet is the cover page, which is as Haverine said, the approval to sell or acquire up to 4 units from the MPDU program into the program that we would use for the use and operation by Jubilee for adults living with developmental disabilities. If we go to page 9 or page 3, the executive summary, I'll just cover this highlight. We've had a long history with Jubilee, and some of you certainly know that history, and I can get into a lot of detail, but I won't. But if you have questions, let me know. You know, this is funds that we received in 2013. They were actually an fiscal year 10, fiscal year 10 was the first year that we got funds. Fiscal year 14 was the second source of funding. With this last source of funding, we went ahead and acquired one home, which is up in Durwood at 10 Horizon Court. There were unspent funds from that grant, as you recall. And the issue basically is that those funds with the state have a sunset provision on them of 7 years. And so by June 30th of 2021, this year, those funds revert back to the state. And so in reviewing that and with some other history that we had working with Rosaria, where they were going to step in and take the homes from us, and they decided not to. We lost a little bit of time, but we would like to use those funds, and it's a combination of both funds from DHMH, the Department of Mental Health and Hygiene, or Health and Mental Hygiene, and also DHCA, who provides your local 25% match. And in combination, that's over $1 million. And what HOC would like to do is, or staff is recommending here, is that we go ahead and obligate those funds. We won't have spent them by June 30th of this year, but we will have obligated them in the eyes of the state. That secures the funds for your use to be able to be reimbursed, so you don't lose the funds essentially. The plan generally is to acquire the homes, they're townhomes, and we'll go to the next slide 4 or to 11. They're in my one back. Sorry, yeah, right there. So these are all townhomes. They're up on in Montgomery Village. MPDU 64 was a portfolio that had a lot of townhomes. There was some single family, but there were mostly townhomes in the Montgomery Village area. And these are 4 of them. They're all on Chadburn Place in that development, and they're all 3-story with 2 or 3 bedroom. And so we've been looking at them. At first, we weren't sure. They don't really fit the model of the other single family homes that we've done in the past, which are more Rambler types that have 2 levels. But they are homes that they're really at grade. You can come in and provide that visitability concept that's so required. You can make the ground floor very visitable in terms of wheelchair access. And in discussions with Jubilee about the appropriateness and fit of these units for their residents, they were very excited. I gotta say, they like the idea of the multi-story. They want the ground floor access and the full accessibility on that floor, but they don't require the access be to the bedrooms in the upstairs. They did want bathrooms provided, and so those bathrooms would have full accessibility to them. But they were also extremely excited about the grouping. We thought maybe there'd be an issue with the idea of grouping them all in this one location, but they really like that in terms of a community and access for these folks, for adults who are living in these homes, to be able to have shared services and shared interests all close by, so they can associate with each other. So that was great news. If you go to the next slide, we basically outlined who Jubilee is, what they do. They are a social service provider to HOC. HOC is really the role here as a landlord, and that is a very strong distinction there at the state, that the social service provider and the landlord be a separate entities, and so that there's not a conflict of interest as it relates to the tenancy. But HOC does serve as the owner and the landlord in conjunction with Jubilee, who identifies the tenants and provides the appropriate services to meet their needs. On the next slide, we talk about the MPDU program and getting these four homes out of the portfolio. And essentially, there is a mortgage, as Karine mentioned. There's that does need to be repaid. That would be repaid as part of the advance off the PNC Bank line of credit. That's about $905,800. And once that mortgage is prepaid, then there's a couple other items. The endorsement from the Maryland Housing Fund policy would be terminated, and that would allow essentially the acquisition by HOC of up to 4 homes, and to be able to be used for Jubilee. Now, the reason we're asking for, we've kind of modeled 3. I'll be frank here. We've modeled 3 because I don't know exactly where the cost of the renovation is going to come in at. If it's less than what we anticipate, we'd like that flexibility to go for the 4th house and be able provide that. But if costs of renovation are where we possibly think they could be, then we'd probably only be able to do 3 homes with the funds because we're capped with the funds from the state. So we wanted that flexibility here. We're asking for up to 4, but it's possible we might only be able to do 3. And it's because of the combination of acquisition cost plus the renovation cost. If we look at the next slide, that shows how I've broken that out. The first, these units are all basically priced the same at the tax assessed value of $202,000. If we did 3 and we estimate that the renovation for each of them was about $120,000 each, with the soft costs for design and permitting and the interest on the line, that would eat up the entire amount of our funds. But as you can see, if the renovation costs are only $70,000 to $80,000 a unit or less, that will leave unspent funds, which we would then see if we could do a 4th home. So that's we're anticipating that we'll probably be only able to do 3, but I've wanted that flexibility to be able to do 4, as I said, just in the event that that the renovation cost comes in a little less. And so the funds would be repaid from the state after we've acquired. We submit that to the state for reimbursement. The reimbursement comes into and pays the PNC line of credit back. Then there's also renovation costs, which we would draw off the line. Those also would be reimbursed from the state, but up to the amount of the grants. So $1,033,000 would be the amount reimbursed to the line, and that additional amount that's left on the line of approximately $300,000. HOC's plan or recommendation would be that in lieu of debt service to the mortgage, we would use that to start to repay the line and pay that down over time, or until another plan is developed for the additional for the other units, the other 60 plus units. And so the last slide really is just our issues and recommendation, where we do ask for a temporary loan to approve up to $1.4 million from the revolving line. Of that, we would pay off the mortgage, and the remaining balance would go towards the renovation. As those homes are sold and the renovation dollars are reimbursed, those pay off the line, and we would defer the operating cost, but that $300,000 as part of debt service. I wanted to mention also that there is an operating deficit funding of $1.372 million against this MPDU 64. That was for funds that HOC advanced to the entity over time, just while it was in operation, and those will not be forgiven. Those are just deferred. Again, we could come up with an additional plan for how those are going to be paid back, or we just use the funds from that would have normally gone to debt service after it's paid back the line of credit to begin paying those back as well. So that HOC is made whole at the end of the day on those advances too. So I'll stop there. If you guys have any questions, please let me know.
This might disclose.
From my colleagues.
Yes, I have a question. This will certainly disclose my lack of knowledge about what's going on here. This transaction, what happened to it on the screen? Who owns these 64 MPD units now?
HOC.
And so we are buying these 4 units from ourselves?
Correct.
I mean, technically, yes, but we still have to pay for the transaction. But yes, technically.
So what entity will? So are we selling these 4 units to Jubilee?
No,
Not directly to Jubilee.
not at all. Not at all.
Yeah, they can't. Yeah, in fact, not at all. They can't be an owner and a social service provider. So
Yeah.
it'll be owned by HOC or a special purpose entity of HOC, just for
That's
that.
what, yeah, that's what I was trying to understand. I mean, we're buying them from HOC who owns them now. So
Mhm.
what is the entity that will own these 4 units?
Yeah, we haven't set up an entity for that yet. It could be either directly owned by HOC like the other Jubilee homes that we have, or it could be into a special purpose entity that's just holds these particular units.
So
Yeah.
right, Jay, right now they're owned by this entity that is known as MPD1, that's wholly owned by the Housing Opportunities Commission. And so we would be purchasing them out of that entity, and they would just be generally owned by HOC, not in a specific entity, just by HOC.
Yeah, I guess my confusion is this, is that why, if we own the units now, why is it necessary for us to essentially acquire these 4 separate special purpose enterprise? And
Because those are
then,
funds.
the funds, because the initial funds that we are talking about potentially losing, those funds were made available to HOC, correct?
Wait, I didn't follow you there, Commissioner Priest.
The thing
Maybe
you're
ask
trying
that
to
again.
do is you're trying to preserve funds that were made available back in
Correct.
2013.
Yes, correct.
Those funds in 2000, who was the entity that those funds were made to? Weren't they made to HOC?
HOC, yes, correct.
But we can't simply take units that are in one special purpose entity that have a set of requirements attached to them and direct the funds. That won't work. That can't work. So we've actually got to purchase them outright.
But the question I think Roy was asking was whether that money would still be available to us if you didn't purchase it. And I think you said that it expires when?
June
Sunset.
30th.
Yeah.
We have to spend that money by June 30th of 21.
Exactly.
Or
Show
else
that
we
it's,
lose it.
yes,
Okay.
show that it's committed.
But so what you're doing is creating these 4 units for a special purpose, which is for a specific target population. What you want to make these units available for, okay? So the reason that we are doing it is multiple. One is we want to expend the funds. We want to expend the funds, however, to make these units, to retrofit them specifically for a targeted population. Is that
Correct.
right?
Correct.
Yes,
That's correct.
absolutely.
They would not be available for anyone else to lease. I mean, programmatically, they would be identified for this specific purpose, this partnership and set of services with Jubilee.
Yeah, and I mean, if what you're saying now had been explained to me in the write-up of this, I would have understood what this transaction was. Because it seemed to me, I'm saying, why do we need to buy from ourselves to achieve an outcome that we could do right now? Other than the fact that what we are doing is we're creating a special purpose population for these 4 units.
Understood. So I'll note, we'll make the change in the final package that goes to the broader commission. I appreciate that it was unclear, and it's my apologies.
What can I? Are you finished, Roy, on that? I mean,
yeah, because I was just trying to understand this transaction, because what we're doing is we're creating, as the last point you made, Jay, was the fact that there were funds like $1.3 million that will still be associated as a debt obligation to the property itself, which are the remaining 60 units.
Yeah.
Correct?
Yeah, exactly.
Okay.
well, I guess I got 2 things. One, receiving this stuff last night doesn't help understand for this morning's meeting what the hell we're doing.
And that's
that's a serious problem. Let me follow up, because I missed something. We got $1 million from the state that is available, which we're going to use to purchase these. And the $1 million is going to be used to pay down the outstanding debt on the 4 that we purchased earlier. Is that correct?
yeah, well, a portion. Well, no, you
800,000.
Yeah, I mean, you have to, HOC has to expend the funds to be able to get
Okay.
reimbursed from the state.
Right,
And,
what,
and so we would do it, and the MPDU has to there has to be an acquisition. There has to be a transaction
mhm.
between the MPDU portfolio entity and this Jubilee entity, which then we would then show the state, here's the transaction.
Okay, so what I'm trying to figure out is,
Mm-hmm.
and again, if I understand it correctly, the properties are valued at roughly 200,000, correct?
Yes,
So we're buying them for 200,000 each.
correct.
Let's assume we buy 4. If we bought 4, that would be $800,000.
Yep.
That gets paid to the MPDU entity for the purchase of those 4 units.
Yep, yes.
And what does the MPDU entity do with the 800,000?
In order for it to sell to the program, it has to actually have that mortgage prepay. It has to prepay the mortgage.
So it will in fact pay off the outstanding mortgage,
Right.
of
So,
which there is more than 800,000 outstanding, correct?
Yes,
correct.
right. 915,000 roughly.
So the other 110 comes from where?
Well, the full amount to prepay that mortgage comes from the line. Like we are using the line of, the up to 1.4 million to actually prepay the mortgage.
So the outstanding amount on the mortgage is in 901,000 plus a little bit of interest for a total of 905. And so the 800,000, if we bought 4 units, would go back to pay off the majority of the amount drawn on the line to prepay the mortgage. And so about 100,000, if we bought 4 units, would remain outstanding. What Jay explained in the packet is, since the mortgage would be paid off, there will be cash flow from operations from the remaining 60 units of the property. And so we would use that cash flow to continue to make payments as if we had a mortgage payment, and over time pay off the balance that's outstanding. And that's associated with the prepayment of the mortgage.
The balance outstanding, meaning the 100
Yes.
plus thousand. Okay.
Yes.
Sorry to extend this, but I'm trying to understand it.
Okay.
When you talk about the line, you're talking about you're not talking about the LOC. You're talking about the MPDU, whatever that fund is, right?
No, in this case, we're talking about the PNC, original PNC Bank line of credit.
Okay. So we're going to reduce the line of credit by $800,000, or the outstanding balance by $800,000. Is that correct?
We would increase the draw on the line by the amount drawn. And once we're reimbursed by the state, we would reduce the amount outstanding by the 800.
No, I'm sorry. The money that was used for the MPDU, the original MPDU purchase, came from where? You said there's a mortgage outstanding on those.
Yes, right. So we would draw on the line to pay off a mortgage. And once the units are sold into this Jubilee program and we're reimbursed by the state, we would take the 800,000 reimbursement received from the state and pay down the line. So reduce the amount outstanding on the line.
Okay, no, okay.
Jay, I have serious concern about this and the grouping philosophically. The Olmsted decision of the Supreme Court urged the least restrictive environment and the obligation to facilitate that. And this is a very, I understand administratively, nonprofits' resources go much further if the staffing and the services can be delivered in a small geographic area. But the county has had a position for a number of years of discouraging special needs housing being geographically compact. And what has happened in several communities is, number one, that the staff became socially among themselves socialized to the neglect of the residents and or the ability of the residents to be able to be accepted in the community. And they end up being re-isolated. And so philosophically, this troubles me terribly because it flies in the face of the practice. I understand the economic motives of it, but I just, I think history in the county has shown that these groupings are not ending up being in the residents' interests. I can think of several MPDU communities where nonprofits purchased, and it's true, it's us that's purchasing them, but the fact that they are grouped, they're being re-isolated rather than provided the opportunity, both from the community's receptivity as well as the circle with whom they are engaged is limited. And I can't believe I feel so strongly about these programs and the work that Jubilee does, but I think we've seen that the county has urged HOC not to purchase units or to offer nonprofits. The most recent one was the Vistas at Cabin Branch, and where 10 units of various nonprofits all got grouped together, and it was not, and the county asked that those be separated out and that be broken up. So I can't approve this philosophically. I think those townhouses are they're small, they're in a very tight geographic area, and my personal opinion is that it's not in the residents, and I know it's not my place to determine Jubilee's programming and decisions, but I don't believe HOC ought to be a vehicle to facilitate the concentration of, particularly of persons with special needs. I think they need access to the broadest community where they will have the most receptivity, and this concentration in that tight, intense townhouse community, I think, is just wrong. and I cannot support this. I'm sorry.
In making a decision about the specific 4 units, what was the basis for those 4? Are they empty units at the present time, or what's the situation? I mean, because we have 64 units in this portfolio.
But not that community.
I'm sorry.
But not in that community. This is in a couple block area, and the scattered site principle that is ideal is that when you walked around a block, you would encounter not more than one special needs home so that people could be integrated into the broader community and benefit from the resources and the interaction with people. And what experience has shown is that they limit their socialization to themselves and re-isolate themselves.
But Jackie, question I have, I think there's a question about the definition of concentration. How many are we talking about? But even more importantly than just that definition, isn't there another nonprofit in the county that serves special needs housing, special needs populations, that has units that are somewhat closer, not in huge quantities in any one development? And I'm trying to understand the difference between that organization, which is very successful and supported by the county, and what we're talking about here.
It's not a matter of being supported by the county. It's a matter of being supported by the community and received by the community in a way that, and when the other situations occurred, the situation became one of functionally a reinstitutionalization of people.
I mean, I understand the philosophical argument that you're making. I'm still trying to get to what I thought was a successful program by an organization that I know you support, as well as a lot of other people. And if I'm hearing you correctly, you're suggesting that their program is not successful.
I'm saying that it is not as successful in those communities where early on the decisions were made to, in effect, co-locate.
But with co-locate, how many? I mean, what constitutes concentration? I guess that's part of the issue. And we're talking 4 units. I understand they're all in within a couple of block radius. But is that in fact the same kind of concentration that we saw early on in these efforts, and which you're talking about were not successful? I mean, the ones that I was referring to have occurred, well, more recently, meaning within the last 10 years. And again, I thought they were successful. And I think that in some cases, the concentration is just a couple of units, but it's successful. So I'm just a little.
Well, we've got, I would ask you to take a look at the intensity and density of those, of Chadburn Place.
Okay.
And how tight that community is. And I think my personal opinion is that 4 is just too many within a 4-block area.
If we were to limit it to 3,
Actually, it's 2 and 2. So
would you feel differently, Commissioner, if we were to limit the number to 3, because that is an option we considered as well.
well, I'd feel better about 3. I still wish that I could live with 3.
I frankly think we'll only be able to do 3. Just the way costs of construction have been rising, as you guys all know. These funds, we only have a set amount of funds, and the acquisitions are pretty set as well. So I think 3 is really the limit.
You know, I think that, I have been very familiar with Jubilee Housing for a long time, from their inception in 1978. I know the excellent work that they have done in this space.
Absolutely.
And we're just talking to the population. And the fact that the staff did take the effort to consult with them about the alignment, the spatial distances between units in the discussion and before they presented this to us, you know, I put some credence in that having great value to me in wanting to look at least the possibility of acquiring at least 3 of these properties and moving to do this. I mean, because it's interesting comment. I mean, because I could make the argument, I think, for why having people closer together in the community has benefit. Because I think it does. As opposed to the isolation sometimes can come from the fact we put them so far away from other people who are in their community. And they have to go so far to be able to integrate and access to services and programs and just living in a community. So I think there's a, you know, we could argue both sides of this, and that's not the issue right now for me, okay? I just think it's a worthwhile goal for us to pursue, especially if we're going to pursue it as a way to commit these funds in a short period of time to get this done and for a worthwhile targeted population. I think you're not arguing against that at all, Jackie. I know you're not doing that. You raised a point about concentration and what that means, and I respect that point. But it does. I do also give great value to Jubilee and their ability to produce positive results for this population.
I think in view of that, I would move acceptance, or
3 or 4.
that we.
I think we can amend it to 3, and then and
All right. Okay. I'll suggest that we refer, or that we refer to the full commission. We have to go to the full commission, right?
Yes.
This recommendation for acquisition of up to 3 units.
Okay.
I second that motion. And the one thing, I second the motion, then I'll just make another point, not on the motion, because I support the motion.
It's been moved and seconded. All in favor indicate by saying aye.
I'm Rick Nelson.
And I will support 3.
Okay.
But
Thank you.
I also would hope that the staff would give significant consideration in the future to the issue and consult with the Commission on People with Disabilities, who has been exceedingly vigorous about this in the past, and engage in a discussion about the philosophy and the benefits, and can get some understanding of both sides of this issue. And like I say, I fully understand the administrative effectiveness of doing this. And I have great admiration and support for Jubilee. My remarks would have been the same with virtually any special needs population that was being addressed.
Okay.
This is just a presentation piece. On the very first slide, it presents four units that are shown in the opening. This one right here, yes. And those are not the 4 units we're talking about.
No.
Correct.
Okay,
No, that's
so
kinda
that's really very. When I saw that out, I had one impression. Then we were talking about the properties themselves are not that. So don't leave with that. That's a misrepresentation.
Roy,
Well, we'll
Roy?
switch it to 3. Those previous 4 are more, background history.
So we'll revise the
And
packet to, per some of the comments that the commissioners have made to give a little bit more background about the program and what we're trying to accomplish so that it's a little bit more clear to the other commissioners as well.
Roy, professionally, I was the realtor that helped them acquire 3 of those units. And the entire focus was to be in entirely different neighborhoods, and that they were already visitable, and went a long way to serving those persons, even who would have some mobility impairments. Short of wheelchair use, those homes were made quite physically accessible. So I'm deeply aware and deeply familiar with the needs and the organization, and I don't want my observations to be interpreted by anyone as questioning the desire and need. And obviously, the more efficiently they can operate, the more persons they can serve. So it's a balancing act, and I just happen to have strong feelings about this balance and the scatterization for any special needs populations.
Let me just pick up on a comment that Roy made. I think the reference to the 4 that we've already purchased with Jubilee, the specific reference needs to be absolutely deleted. There is no reason in a public document to picture them with addresses and
Yes.
identify them as special needs housing that is part of the program. I have no problem in terms of suggesting that we've done this before, but you can leave it at that. And the other piece, of course, and I think Roy hit on it very well, is you open this packet and you think it's about those 4 properties, and it's not. I mean, so anyway, change the packet.
Yes, please.
Can we move on?
Yes, let's.
Thank you very much.
The next item before us is Stewart Town Homes and the authorization to select a firm as tax credit investor, and authorization of the executive director to negotiate and execute an operating agreement. Karine, I believe Zach and Gio or Gio.
Mainly Gio for this one, Gio Cavalazzi, and Zach will discuss this item. You've seen previously a development plan which you approved, and previously a selection of a different tax credit syndicator. And for a variety of reasons, which Gio will discuss with you, we are changing course a little bit to for the benefit of this development. And we're selecting an alternate tax credit investor for it. And I'll turn it over to Gio, who will highlight the key points and answer your questions. Gio, please go ahead.
Thank you, Karen. Good morning, commissioners. My name is Gio Cavaladze, Real Estate Division. And as Karen mentioned, we presented the final development plan for this Stewart Townhomes renovation and re-syndication back in November, December. And at that time, we mentioned that we're exploring an alternative tax credit investor proposals because the investor at that time, their terms had limitations that didn't allow for HOC to underwrite this transaction and take full advantage of it for HOC's interest. So we talked to several syndicators, received 2 LOIs, and which are presented in here, and we are recommending CREA LLC and asking the commission to authorize us to select them and to proceed with the negotiations of the operating agreement. So if we go to the executive summary slide, slide 18 in that packet. So these mostly is the same information you saw in the development plan, but towards the bottom, just goes over what I mentioned and updated transaction summary in terms of the sources of funds. The CREA proposes to pay 92 cents per dollar of equity. And R4, the other proposal we received, was at 88 cents. These are at, as a result of the legislative changes in December, we are now able to structure this transaction for 4% fixed applicable rate, which allows for a significantly higher tax credit equity to come in this transaction. And we'll see a source and user table later on. So
just real quick. So commissioners, what that really means is that where we saw tax credit pricing into the early 90s, 90-cent-ish range, it was compensating often for a fluctuating rate, as Gio just pointed out. And so at this moment, the vast majority of syndicators are predicting that there will be a downward adjustment in overall pricing, but that greater number of deals will actually get done as a consequence of that change, and the consistency adds to a greater level of quality and potentially interest even from tax credit investors. Now, all that said, new entrants into the tax credit market will be helpful in bolstering prices. And so, we're really kind of standing by to see what happens. But so far, we're seeing a downward adjustment into the high 80s in this market. There's still some that are into the 90s, but it's not this particular market.
So 4% credit transaction.
yes,
Yes.
4%, correct.
If it were a 9%, you would be seeing fireworks on the screen right now. We just, there's a fair amount of overlooking Montgomery County. I'm sorry, I was trying to think of the most appropriate word when it comes to 9%.
Thanks, Stacy. If we could go to slide 20, 2 slides down. This is a summary of the terms from the 2 proposals. Side by side, as you can see, mostly they are the same. The paying schedules are approximately same. The only major difference is the price, 4-cent difference. And for this transaction, for the size of the equity, each cent is worth about $111,000. So that makes CREA's advantage about more than $400,000 overall in equity terms. R4 did offer slightly sooner paying of a small percentage of the equity, but overall, even if we take into account the timing differences and the present value of that 5%, receiving that 5% earlier, it's just not enough to overcome the price disadvantage that R4 has to CREA. So so for this reason, this is I think a easy recommendation to make. We're recommending a selection of CREA as the investor to this transaction. If we go to the next slide, I think that that gives you the information of why we went ahead with the the replacement of the investor. So you can see here the CREA's offer and Boston Capital's offer that we had in our development plan. So Boston, like Stacy outlined here, Boston Capital initially had a 96-cent offer, but as Stacy said, that was at a fluctuating applicable percentage. And the way that the investors price these proposals is they allocate the losses from the future losses from the transaction, like interest expenses and depreciation expenses, et cetera, to the fixed amount of equity they're providing. And so if the equity amount is lower, as it was before, at a lower applicable percentage, the yield to the investors allowed for a higher pricing. With the equity amount actually going up, for them to maintain the same yield, they would have to adjust the pricing down. But overall, if we do lose a few cents worth of equity as a result of going to 4% fixed applicable rate, but with the amount we gain as a result of that, it far outweighs the loss of the equity as a result of the pricing. So, this to the right of this table, you can see the changes in the transaction as a result of going with CREA instead of Boston Capital. The biggest difference being that we are now able to underwrite a much higher level of senior debt, and this not only reduces the short-term debt we need to meet the 50% test for these transactions, but we can also lower the seller note amount in the transaction that HOC extends to this project. So yeah.
What is the, is the final figure from Boston Capital 88 cents? Is that their price? Because I see in this slide it says 96 cents.
Well, 88 cents was actually for R4's proposal now. So they were proposing 88, and that compares to 92 cents. This slide, what I'm trying to present here is the advantage. This is Boston Capital's previous underwriting that we had received back in March compared to now. So this outlines the reasons we decided to, delay the transaction closing slightly and change the investor in the transaction rather than continuing with the Boston Capital offer. So this is a comparison of the present underwriting with the past underwriting, and why the decision to go with the new investor that does not limit the senior debt size in the transaction is advantageous, and what it allows HOC to do. Yeah. But so one more thing to point out here, as Stacy mentioned, these 96.5 cents that Boston Capital proposed was again at a fluctuating applicable percentage. And we didn't ask them to reprice the deal at 4% fixed rate, but if we had, very likely their pricing would also come down. So the comparison, the advantage of the CREA offer would show an even bigger advantage in that case. So, if we move on to the following slide, I think. This outlines the ownership structure, which didn't change, and you already saw this in the development plan. But the next slide summarizes the sources and uses of the transaction. And as you can see, it's mostly the same information. Our short-term debt requirement for the 50% test goes down significantly. The seller note also goes down, the one difference between the previous underwriting and this one is that there is now a bridge loan requirement that HOC has to fund. But we'll address this in the financing plan. It's just under $4 million bridge loan that we project. The following slide outlines the information that you already saw in the previous packet, so I won't spend too much time on this, but this just summarizes the HOC's plans for the property and underwriting the transaction at the level that the CDA requires. I think if we go to the next slide, I think I guess one result of this change in the investor is that we were planning to close this transaction in February or March earlier, Well, these contributed to the delay, but it is not the only reason for the delay. We are also still expecting a 42M letter from CDA, and there are some other factors that wouldn't have allowed us to close the transaction in February anyway. But we are projecting the closing to occur in early June now, and the construction schedule and phasing stays the same. And we project that by the end of year 22, the construction will be finished, and a few months after that, we'll convert the transaction to permanent financing. And with that, our request again is to approve the selection of CREA as the tax credit investor, and request to authorize the executive director to negotiate the operating agreement with them.
This requires the board's approval, commission's approval, or this provide just for information to us as a committee?
We require approval from the commission.
It does require approval from the commission?
Yes.
I believe so, yeah.
Well, then I'm just trying to be clear about what the motion should be. I make a motion to support the staff's recommendation to recommend Creo as the tax credit investor for Stewarttown.
Second.
And moved and seconded. Any other questions of the staff? I'd just like to say I appreciate your re-examining and finding this more favorable opportunity, and I fully support it. And I guess for the record, all in favor, say aye.
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 Thank you.
Thank you.
Can I offer a comment?
Sure.
And it relates to HOC's policy on replacement reserves. I mean, I guess we're technically complying with CDH requirements. I'm not sure actually under FHA, what do they normally require for replacement reserves?
Karen,
250 per unit.
Per year?
Yes. Yes.
Well, I mean, my problem is that our replacement reserve gives us enough money to take care of ongoing issues and stuff that you don't really anticipate. But the fact is, because we're going to be the long-term owners, we know as experience has shown us, in 10, 15, 20 years, we're going to have to go through some major rehab. And replacement reserves is not going to at all help us in that regard. If I follow through the numbers on this, after 10 years, we'll have $5,000 a unit collected in replacement reserves. Double that, I guess, for 20 years, which means that we'd have to start almost at ground zero to get the funding necessary, which will be considerable at that time. And so in some respects, we're hog-tying future commissions. And I know it's difficult to build a pro forma, operating pro forma, based on increasing the replacement reserves. But we just are not going to have, a future commission is just going to have to go through this same issue of trying to identify where and how we can get significant equity and capital funds to do the job that's necessary. And I just think as a policy matter, we need to discuss it and/or rethink it.
and you want, Commissioner, some level of history buttressed by obviously the numbers to be the floor of that discussion. Yes. Basically, you want us to take a look at what we've done in the past,
well,
and sort of bring it forward.
I mean, if I'm the only one who's concerned about it, that's fine, and you don't have to worry about it.
No,
I just think as a matter of policy and planning, we ought to think about whether we seriously think that minimal requirements by funders notwithstanding, is this sufficient to provide some kind of cushion for the commission at the time they have to go through some major renovations? And if it is not sufficient, is there any alternative to helping them? Or are they just going to have to be on their own to find the big bucks?
So, all right.
I mean,
so
that's an oversimplification of it, but that's sort of where I'm coming from.
I get the gist.
So,
And I'm not asking you to spell out what you do. I just think you need to.
I think it's a matter of the definition of what we're talking about in terms of replacement reserve. Because and I understand the point you're making, Rick, but if you were trying to build that into the pro forma in terms of being in 20 years out of having sufficient money to rebuild without a major refinancing, that would, you'd never build anything.
Okay. I agree with that, Roy, but is there a way that you can at least have sufficient monies that the equity requirement in 20 years could be possibly better satisfied than it is right now? We don't have anything built in really
Yeah,
to address the equity. I know we're going to have to refinance.
right. Let us huddle, because I mean, part of it, just real estate, fundamental is that there's the latent equity is generally what you're relying on to buttress it. But I mean, I understand your point, right? Because we never know where we're going to be in that moment of time. We never know what the financial markets are going to be, and to put that entire burden on a future commission, a future staff, given that the property is a going concern, anything we can do to mitigate that would be helpful. So yeah, I think it's a good point. And
but I guess the latent equity is, I understand that, and I guess sort of part of the problem there is, as the continuing owner, we're not able to tap into all that latent equity to support our share of the financing in 20 years. That's the problem. I don't know that we can't address that because it's the way it is in terms of financing, but I just want to see if there's a way for us to better prepare the commission to be able to bear that burden of having to share the HOC cost of refinancing.
Yeah, I think it's a valuable consideration. I think the thing about the assets that we own is a building, and so often what happens is that by the time you get to a point where you've got to refinance a building, enough investment has not been made to keep the building in such a substantial position that it realizes the full equity value of the asset. You know what I'm saying?
Mm-hmm. Mm-hmm.
And so we've got to figure out a way, because that's the biggest thing we have really at the end of the 20 years, is having a great building that's still in great condition, and in fact could be refinanced again, and you can garner out and take out all the equity that's been built in, because you've got still a substantial asset. I think that's really what we want to try to do. Because that so often does not happen, especially when you're talking about affordable housing. And the thing that's always concerned me about replacement reserves is that in a lot of our buildings, when we get to a major systems need, there's not enough money in the replacement reserve to even cover a major system replacement. Okay, and so then that is the downside of the building, your asset depreciating, because you're not being able to capture the full value of the building because we haven't maintained the building. So you got to keep the envelope. So I totally agree. There's a way to do that. You should think about it.
Okay.
If I could just
item on a future agenda.
Yeah.
I think Gio had something to say.
Oh, no, I understand what you're saying, Commissioner Nelson. I guess addressing that through the replacement reserves would affect the NOI, and affect the transaction at present. So it may be not the best way to address that concern through the replacement reserves, but that can be addressed some other ways, because capturing that value at present would be affected if we were to.
I don't care how it's addressed. I just think that somehow we need to figure out a way to address it, because right now the system for long-term affordable housing owners like us doesn't really provide us the vehicle to do it.
Yeah, and what we've done in one of the recent transactions, I can't remember which one, but I think it was Green Hills. We had two components of the replacement reserve, in that we had a portion that was included in the operating expenses as a must pay. And then we had, so as not to curtail the amount of the debt that we were able to raise, we put a portion after NOI, so that we're funding two parts of it. So we'll look at it, and Zach and I have started to talk about, as we're presenting these transactions to you for consideration, to create a template where we're looking at the physical need and looking over the years at systems replacements and things like that, and how the reserve gets used.
Okay.
And try to answer your question: is 5,000 per unit at year 10, is it enough? And if it's not, how do we get to what we think is enough? And what does it mean for operations as well as for the impact to the agency? And come up with a reasonable response to what we know is important to the commission. And it may be that we can get there or that we can't, but at least we'll tell you, and that's up to the commission to make a decision on a project by project basis. And that's the best we can offer right now, and it's a discussion point that will be ongoing.
Okay, no, that's all I asked. That's good, thank you.
Okay, are we ready to move on?
Sure. And the next item.
Karen, 1 second. Did we have a vote?
Oh,
I thought
Yes,
we
we did.
did.
Yeah.
Did.
Well,
Okay.
We did it. We did, and then we,
yeah, we did, because I waited until after the vote to
Yeah.
Yes,
raise my point.
Okay, so the next item is related to this Stewarttown discussion. It is about Stewarttown, and it is amending the finance plan to reflect the changes to the development plan, which Victoria Dixon in the mortgage finance area will review with you. So Victoria, handing it off to you.
Good morning, commissioners. So, as mentioned, revising the financing plan to recognize the changes being made in the amended development plan. The new LIHTC investor, including a ask for the new bridge loan of up to 4.6 million, and a resulting increase of the volume cap and bond authorizing resolution by $500,000 for this transaction, for a revised amount of 16.5 million. Previously in January, the commission approved the final financing plan, which totaled an estimated $38.1 million, which contemplated the permanent mortgage loan, tax-exempt construction to perm, backed by FHA risk share, up to 16 million to be funded by the issuance of bonds, the LIHTC equity, the subordinate seller's note of up to 12 million, and contemplated assignment of the existing county loan to the new entity. The mortgage loan under the previous LIHTC investor was restricted to a maximum of 11.7 million or $125,000 per unit. With the new LIHTC investor, the current underwriting for the transaction now assumes a permanent mortgage of approximately 15 million can be supported at a 1.5 debt service coverage, using an all-in interest rate of 3.369%, inclusive of a cushion against rising interest rates. The increased sizing of the mortgage loan of approximately 3.4 million reduces the short-term bond and seller note needs for the transaction, as shown in the updated sources and uses. Should interest rates hold and the cushion be removed, sizing of the mortgage loan could increase further. Due to revisions of the scheduled availability of sources, the transaction is projected to require up to 4.6 million of bridge financing until repaid from the receipt of the LIHTC equity installments. Staff proposes to utilize short-term taxable draws on the PNC real estate line of credit to fund this bridge note with a maximum term of up to 30 months from closing. With respect to the volume cap allocation and bond authorizing resolution, the transaction will also require sufficient volume cap to fund a bond debt service, a reserve equal to 6 months, estimated at approximately 320,000. When combined with the revised short-term bonds and long-term bonds being issued for the transaction, the total volume cap and private activity bonds required exceeds the existing $16 million allocation. Therefore, we are requesting to increase by 500,000 to our revised 16.5 million. The amended bond authorizing resolution will also correct the name of the bond series being referenced. Will the Development and Finance Committee join our recommendation to the Commission? Are there any questions?
One
Any comment?
one point I would make, in these proposals where we're talking about using the line for bridge loans, I assume that somewhere back in the office you are doing a timeline of what we're borrowing, what we're paying, and all that sort of stuff, like we do with the OHRF. But you don't make the definitive statement in here that yes, it is possible in terms of the ins and outs of that fund that we can manage it.
So there are covenants on the RELOC for what we're permitted to use, and those were evaluated assuming the use for this transaction to make sure that we would not.
Yes, we're tracking it, Commissioner.
Okay,
Yes, we're tracking it.
thank you. I would move support of the staff recommendation.
I
There's a
second it.
second.
I second it.
I then call the question. All in favor of moving forward to the commission, the staff's recommendation, indicate by saying aye.
Aye.
Aye. We're unanimous.
Thank you.
Thank you.
And I believe that was the last item on the agenda.
Yes.
Today.
Is there a motion to adjourn?
So moved.
Second.
We are hereby adjourned.
Thank you.
Thank you.